All trading videos by OFA are for educational purposes only to illustrate sample use cases of the software functionality. OFA is not a trading system or strategy being marketed on a performance track record of live or hypothetical results. Trading involves substantial risk. Please do not purchase or subscribe to OFA services without carefully reading the complete required disclaimers and terms and conditions located on the OFA website. In today's lesson, we're going to talk about trend following. So in prior lessons, we've looked at fading off of decision points. We've also looked at taking reversals off of double tops or double bottoms. Today, we're going to focus on what happens when we have breakouts of ranges. And in this case, we have a nice consolidation range that was created from about 7 to 8 in the morning. You can see we have a low down here and a high, and then that high was retested and tested again, and then on the third time, we finally broke out and started a trend up. And so we want to look at how we capture parts of that trend, the tools that we can use, the strategy that we want to use, I think is probably more important than the tools. A lot of people get very focused on tools doing things for them, but if you don't understand the strategy behind it, you're going to fall short at some point. So what I'm going to do is put a profile on this swing up, and it's going to be what we call a swing profile. And that will have a certain tool set already built onto it. You can, of course, change that and set your own defaults for it. But I think it's important that you have an idea of why we've put the tools there. So let's grab from the menu an active swing profile. I'm going to start right down here. And the reason I'm starting at this point is because this is the lowest low at the beginning of the upswing that broke out of the consolidation. So I'm going to place it here and just drag it right on across and drop it on the right-hand margin. Now in this, you're going to see that we have a standard profile over here, and it shows that we're currently inside of value and there's a point of control. But more importantly, we have this little blue line. This is the CWAP, or Cluster Weighted Average Price. And what it is a proprietary indicator that we use for following the trend when we isolate swings like this. So because we can see the swing moving from a low to a high, we can then infer from that if we use the volume average of where volume was executed in that swing, we can tell whether or not we're above the average or below the average. And because we're above the average, we're expecting the market to continue. And obviously, if we crossed over the average, we would expect the market to start moving the opposite direction. Well, the average is this red line right here. This is our volume weighted average price. And you can see that this blue line is a little bit in front of it. So the calculation, instead of using all the volume, we're just using the volume inside the isolated clusters for this swing. So that gives us a bit of an exponential move. So I'm going to go ahead and put my order out there, and then we'll talk about exactly what it is. So my order goes out at 70.25, so that's just a little bit in front of this CWAP line, and you can see that's where I've sent it to. CWAP and then +1 is an offset. Now you could just as easily use the exact CWAP number. You'll see that the market crosses it. It's not, my personal preference usually is to get a tick in front of it. It really depends on which market it is as well, and those are the kind of things that you're going to have the ability to fine tune. More important than just where the order went, though, is the algo that I'm using. So in this case, I'm using the volume weighted average price for my stop, and you can see I'm one tick behind that. And I'm also going to use the VWAP for all of the management of this trade. Now that doesn't mean that I'm just going to leave my order at the volume weighted average price, but logically, if I'm in a directional swing, the VWAP is always going to be sort of the line in the sand, the last possible place that the market should trade if we're going to continue moving higher. So again, focus on the strategy, not just the tool set. People like to see red and green, and they like to see neat little tools on software. But software is only a small portion of what it's going to take to become a successful trader. You need to understand the strategy behind it. It needs to make sense to you. If you can't follow and test and challenge the logic, you're lost, and you might as well be going out to Las Vegas, right? So here is the order just got filled. We have a 10-lot position on, long from 70.30, and our stop one tick behind the volume weighted average price comes in at 7,000. So that's a 6-tick stop. That's giving us a 12-tick initial 2-to-1 target. And again, that's just based off of my standard algo that I use for basically all of these trade examples. So why is the VWAP so important? Well, if we're in a directional move, and again, that's what's so important about OFA, you're capturing an event in the market. In this case, the event starts at the low that created the breakout that is now showing us the trend. Okay, so when we have a directional move like that, we know through the calculations where the average of all the volume is. And if we're trading above that average, it stands to reason that the market is going to continue to press higher, or that we're at least going to find support there. If we start trading through the average, we're now the current market price is now below the average of all the volume in the isolated swing. It would stand to reason that the market has turned over and is starting to go the other direction. So what a wonderful place to use a trailing stop, right? Something that's dynamic. People tend to get lost in the idea that they're going to use a 6-tick stop or an 8-tick stop or a 7-tick stop. And generally that's the result of somebody else telling them what they should do, or a backtesting result. And we all know what backtesting is. We're kind of form-fitting something into a strategy. Why not use the actual data from the market and have the market condition tell you where your stop should be? By doing that, what we can physically do as traders is make the decision as to whether or not the risk is worth it. So in this case, I know that I need to have my stop behind the volume-weighted average price. Let me zoom in on this just a little bit so you can really see it. I've got to have my stop behind the VWAP if I want to follow this strategy, right? So that means that I can look and see where the CWAP is and say, well, I want to take that trade there, or I don't want to. It's going to cost me too much, right? So if there was a 20-tick spread between the VWAP and CWAP, and you said, well, I don't take stops that big, it's not worth it. Well, then you're using an actual logical strategy and not just something that is, well, because one line's here and the other line's here, I have to take the trade. Right? I would rather know what is the last place that a stop should be for this trade to work out, and then I get to determine whether or not that risk is acceptable to me. Now, obviously, I want to have a risk profile that makes sense. I don't want to just pick and choose. But as an example, for me, it generally doesn't make sense for me to be taking stops more than about 8 ticks. Now, that's not because 8 ticks is some magic number. It's because if I think about what I have to get out of a trade to get at least 2 times my money of what I've risked, that means that the market has to move at least 16 ticks, right? If it's an 8-tick stop. 16 ticks I can handle. That happens all the time just on bounces, particularly in crude. But as we uptick from there to 9, that means I need to get 18, 10. I've got to get 20 ticks out of the market just on my initial move. And so the larger the stop, the harder it is for me to get that initial multiple. And I like to make 2 to 1 on my money every time, right? And it doesn't happen every time, but that's my objective. So in this case, with a 6-tick initial stop, I've got a 12-tick initial target. That's nothing, right? All we have to do is come back up and double top, and I'm getting paid. So that's the overall objective there. And then once that 2 to 1 is hit, then I'm going to get a 3 to 1 and a 4 to 1 and a 5 to 1 target that's going to spread this out. So what I want to do is I want to think about where this trade might be going, right? If I'm lucky enough to get my 2 to 1 and my stop's going to keep increasing with the volume-weighted average price, and hopefully this CWAP is going to continue to provide support. Just look at how wonderful this support has been so far. We're coming down to it, we're bouncing off from it. Coming down to it, we're bouncing off from it. Even early in the move here, which is basically when we would have recognized this as being a breakout, you can see we came very close. You wouldn't have been filled with an order right on the CWAP, but you can see that it is providing support, and that's the type of thing that you want to see in these trades, because it helps you with the idea that you should expect support at those levels. The more you see it, the more you're going to subscribe to the theory behind it, and you're going to start challenging it and testing it. And will there be times when the CWAP doesn't hold? Absolutely. Of course there will be. The market can't track a single indicator forever. But when you start to see that your position is creating support, and it's not just at one price, right? Each new influx of volume is changing the level of support, and we're climbing with it. Now, what we want to think about is, if this trade actually goes, where might it trade to? Right? Where might this be going? And so in order to do that, I want to take a bigger look at the overall market and see where we've been trading. Well, this is the day so far. We have a low down here. We have a high up here from about 2 a.m., so the London session open. So I want to go in and see what this high looks like and see if I can find a decision point there. Now, in a previous lesson, we talked about decision point trades. I'm going to put that profile right there. And so let's just assume for the purposes of discussion that we were flat right now and we were looking for a trade. Well, logic would tell us that having a nice big range in a market like this, that if we were to trade up to the high or down to the low, and I guess I can put the low on there as well, that we would want to fade off of these key points. So we have a profile on the low decision point and a profile on the high decision point. And in this case, I've already got the point of control marked off here. We would normally be trading one tick in front of it. So if 72.60 is the point of control, we would be looking for a short entry at 72.55. Okay, so that means that if I'm already in a position, shouldn't that be my target? Makes sense, right? There's logic behind it. It's not just, well, I'm going to put a random order out there somewhere because I like to make 25 ticks on my trades. So in this case, I know that if my trade starts to take off, I ought to be shooting for 72.55 as my upper target. So let's zoom back in and take a look at our trade and see how that CWAP is working as support. You can see even once again, we've come off of it. This is 1, 2, 3, 4, 5 times that we've held exactly at it. We also picked up our 2-to-1 take profit. So this is now a 3-to-1 target that's gone out. Always nice to make 3-to-1 on your money. Nothing wrong with that. And you can also see that our stop is now reduced. So we only have a 4-tick stop on because our stop is dynamic. It's moving with the factor of the market, right? If I'm in a swing, an isolated swing that I can calculate the volume weighted average price from, that is where my stop should be. And the more volume that comes in, particularly at the high end of that, the more that level is going to move. So it has moved up 2 ticks, so my overall risk is now reduced by 2 ticks, and that's really important as well. We now have 6 points of support off of the CWAP, and you can see we're now just coming into our 3-to-1, and there is our 4-to-1 target up above that. Now I'd like to bring your attention to the fact that we've actually broken away from the CWAP, and there are many times where you might miss a trade, or let's just look at the sequence of things here. So here is where we probably would have first recognized the opportunity for a CWAP trade, but we wouldn't have gotten it, not unless we were leading it by several ticks. Then we break away and we come back to it. Right? Here is the opportunity that we took to get into the trade at the fill. But we've come back to it multiple times, and now we've broken away again. Let's assume that you didn't have the opportunity to get into this trade earlier. Think about where the CWAP is falling right now. We have a CWAP at 70.60. We have the point of control at 70.70. The VWAP is only down right now at 70.25, so you're really not that far off of it. So even if you weren't in a trade right now and you wanted to go long in front of this or at it, let's call it from 70.60, you would have a stop of 1, 2, 3, 4, 5, 6, 7, 8. 8-tick stop. Even after the fact, you'd still have an opportunity to get into this trade. The fact that the CWAP and the point of control are basically lining up just adds to the value of the support, right? So as we come back down into this, if you weren't in the trade or for some reason you had gotten scared and jumped out of the trade at the upper standard deviation, here is your second opportunity. Look how the point of control and the CWAP are converging. Fantastic opportunity to get into the trade late if you haven't. And you've been shown the support all along, the entire trend. Why wouldn't you trust that it's going to hold again? So we have penetrated the CWAP, but not by more than a couple of ticks, which is an important thing to remember. Usually it's going to hold very tight. And we now have our stop reduced to just 1 tick. We only have 1 tick of exposure here on the trade. So even though we've traded through the CWAP coming back down, we only have 1 tick at risk. and we are looking for the market to hold and push back up to the 4-to-1 level. So the CWAP holds an additional time as we continue moving higher and looking for that 4-to-1. You can see our stop is now at entry. We can also see that the CWAP was only penetrated by a couple of ticks. So breaking away from this again, we might want to look at jumping our stop forward and using the CWAP, maybe just offsetting it by a couple of ticks so that we're a few ticks behind it. Obviously, coming back to the point of control is a fairly logical thing, so we wouldn't want to move it directly to that price level. But maybe after we've come up and hit the 4-to-1 while we're trying to hold on for this target up above, we might want to advance our stops so that we're not just trailing the volume-weighted average price, but actually leading off of that quite a bit. Now, the VWAP is always going to be in a swing. That's always going to be your critical level for a stop. So if you're trying to hold a trade as long as possible, it makes sense that you would want to use the volume-weighted average price and not anything in front of that. But at some point, you're going to have what's termed a mean reversion. So at some point, we will find a high, and we will push back down towards the mean or the VWAP. So we want to be aware of that. But if we're looking to protect a little bit of profit, we could use the standard deviation as guidance for a stop. We could use the CWAP. In this case, because we've penetrated it by a few ticks, I might go in and select the CWAP and maybe offset this by 3 ticks, move my stop up just a little bit, get a little bit more out of this if things don't go as planned. So looking for this to trade up to that decision point up above. And there is our 4-to-1. So here's our 5-to-1 target. Rather than leaving that at 5-to-1, let's go ahead and take that up to the 55 that we talked about. Now, why the 55? Well, if we go back and look at the high of the day, and just remember, imagine that you're not in a trade. What would you do? Well, my expectation would be that if we trade up to the top, I would try to short the top. Why? Because it's the high of the day. It's a major reversal point, and I can see the transition. It's a perfect distribution point, meaning there is a nice normal distribution, and this would be a trade from 55 with a 6-tick stop at 85. So that is what I'd be looking to do if I wasn't already in a position. So therefore, I need to take that piece of information and use it as my target guidance. So my 5th and final target out at 72.55. I'm going to zoom in here. Once again, it looks like we're holding support just above the CWAP. So look at the number of times that we've just grazed along it. And here we are once again, just a couple of ticks in front of it, still finding support in this uptrend. Once again, the market trading back down towards the CWAP. My stop just a few ticks behind it. Now that we've had a nice advance, I don't want to give up too much on the trade all the way down at the volume-weighted average price. But again, hoping that support is found here, just like it has been numerous times in this swing. So we can see the market expanding up towards our target. Remember, 72.55 coming off of the prior decision point from the high of the day. And ticking right up into it. And you can see still holding the other side of value from the top of the decision point. This is where we would be looking for a short if we weren't already in a position. So looking for the market to turn back the other direction now and potentially move into the volume-weighted average price. We'd be looking for a mean reversion off of this move now. So just to go back through this quickly, the reason that we've selected this period to start the profile is because this is where the breakout takes place. If we start the profile back here, we will have already crossed the volume-weighted average price or the CWAP. This is sideways consolidation. This is not a breakout swing. And so when we see the breakout swing happen, which in this case we would have seen it happen about 8:25 to 8:27 in the morning, that's when we're going to go back and we're going to look for the lowest low to start from, the lowest low of that swing. And that is going to provide us with an isolated event in the market where all of these calculations can provide us with enough feedback to actually trade off of them. Right? We're not just using random starting points or saying, well, from the beginning of the day, well, the market's moved up and the market's moved down. We don't want to use the beginning of the day to isolate a swing. The swing needs to be specific to when that swing took place. And in this case, where did the buyers come in that began the drive? They came in here. So we're going to start, and we're looking for that CWAP as our opportunity to go with the trend, and always using the volume weighted average price as our stop guidance.